Good morning, everyone. In the heavy weather out there, I thought I'd start on an interesting note. And it actually deals with watching a plane land at Cape Town International on our way here. We'll start with a bit of aviation information for everyone. I don't know if you're aware, but the average pilot that enters cloud gets spatial disorientation in 15 seconds if they're not using their instruments. In fact, the ears generally take over because we all default to balance. We don't have a visual context in clouds. We don't have a horizon, so we default to our ears. And the ears are the liars of the aviator. They don't tell the truth. You think you're flying straight, but you're actually descending or you're turning. And the theory, aviation theory, actually is quite interesting. The literature says that the problem is you default to an illusion, and that illusion stems directly from your ears. It's your balance. Now, we have exactly the same thing in finance, believe it or not. It's called anchoring bias. And in the literature, finance literature says that anchoring bias is the assumption that price is always correct, and that's without performing any form of valuation work. So we all have that. We always think that price is right. It's a natural disposition for all of us. Now, I'll give you some examples of why that isn't the case. You'll all be able to resonate with this immediately. In 2016, Steinhoff hit 96 Rand 85. In Sanlam in 2003 was 5 Rand 80 on a 20% yield. It's now $100. And in 2000 March, Cisco reached $80. It reached $25 in the same year and took 20 years to get back to $80. So clearly price isn't necessarily right. So price, we would say, is a little bit like the ears to the pilot. It's the liar for the finance industry. And valuation work and research are like the instruments for the pilot, for us in our industry. The problem is most people just see price. Most people in the industry don't spend all day long doing valuation work. So I started like that because the quality index is under extreme pressure at the moment, and most people you speak to in big audiences suddenly say quality is dead, don't buy it. We've called our presentation, this is No Time to Blink, and the first graph really just shows the quality index's performance against the market over time. And this is a broad market, includes emerging markets. If we look at the performance on an annual basis of the quality index, we can see that it's definitely at a tough time just of late. But most of the time, it sits above the market, even on one-year rolling basis. If we look at the value index, which everyone's defaulting to now, it's performed much in line with the quality index, but actually with quite a lot more volatility in blue. So the standard deviations around value is very, very high. You incur big ups and big downs. What we've done is we've said in our business for many, many years, let's add quality and value. Let's buy companies when they're cheap, but good businesses. The outcome is actually the pink line. You get very, very strong performance by buying undervalued quality businesses. But you do get some volatility in pink. More than you get out of quality, less than you get out of value. And if we sum that all up, quality gives you a very high, quality value mix gives you a high return, get a lot of bang for your buck. You do get some volatility, certainly less than value, but more than quality. But the outcome is outstanding. But in the last 2 years, quality's been beaten. And that's really where we come to now. And why is that the case? And we think there are probably two reasons why that's happened. One is technical, and the other one is fundamental. The technical reason is that most of the capital has gone in two directions. The cyclical part of the market, so oils, materials, even utilities, maybe less cyclical. So it sucked capital in that direction, and it sucked capital to very expensive part of the market where the hyperscalers sit and some of the semis sit. So very expensive companies and very cheap companies, and it's really sucked it out of the middle where a lot of the quality businesses reside. So that's maybe a technical reason. A fundamental reason, and there are actually three of them, and I'll really discuss that today as briefly as I can, is that we've had three things happen. And I have to really skip some of the slides, but the one, and move quickly because I don't want to overstay my time, but the one is really around GLP-1s And if you look at the way the quality index is constituted, 71% of it is medtech facing, facing the consumer or facing technology. So those are the three areas where quality kind of operates. And in each instance, there's a fundamental reason why they're under pressure. So in the GLP-1 space, this is attacking the historical businesses that are invasive in terms of fixing people, operations and things like that. Now you can take a tablet, hopefully lose weight, cardiovascular improvements, et cetera, largely untested still, but certainly damaged the industry in terms of the large medtech stocks being derated downwards. And you can buy some of these companies on less than 20 times multiples. It used to trade at double that in the past. And you can see the derating of the healthcare sector. The second is the AI trade on the tech industry, particularly the SaaS players or the companies that offer service. And here too, we understand that you've got a problem in the industry and that there's a new technology that might disintermediate some players. But the counter argument is that there's trust and compliance with your existing supplier. They're vertically integrated in an entire industry, and you tend to find businesses take a long time before they can an operator or change to new technology. And I've had time, I could show you so many examples of those. And then, of course, SaaS operators have all the proprietary data on their clients, and that data is very useful for improving their businesses. So those are three counter arguments. You can buy many SaaS companies at less than the market's valuation these days. And then the last real problem against quality is the consumers being under pressure. So we just show a graph here of Hermes bags. So anyone that's interested in buying a Hermes bag, I think some of them cost $20,000 a bag. This is the second-hand market, and you can see the top graph and how the second-hand market's devalued a lot of Hermes bags. So the consumer's under some pressure, even the most well-to-do consumers out there. So those are three reasons why quality is under some strain. Now, here's an example. It's probably the poster boy of the tech industry in SAP. It's come under extreme strain. And the view is that AI will disintermediate SAP. Now, SAP touches 77% of transactions in the corporate world. And I don't have time to really go into the details here, but I'm going to tell you what Jensen Huang said about SAP and AI in particular and the SaaS industries. And this was at the Cisco conference in February 2026, so the other day. He said, AI will not replace software companies. AI are tools, not replacements. These are all quotes, direct quotes. The replacement narrative is the most illogical thing in the world. I think the market has got this wrong. And if you don't believe him, in Q4 2025, 90% of SAP's new business was in the AI side of things. The next business I'm not going to go into in detail, but it's Reckitt, a business we own. You can buy this company on literally the same multiple as Tiger Brands in South Africa, but it's one of the 15 largest consumer movement goods companies in the world, and 60% gross margins that the business operates at. It can defend its portfolio. So, we think there's a lot of irrationality in some of the way these businesses have been valued. Now, just getting on to some slides on our own infrastructure. This represents our discount on our buy list. So we cover 100 companies, and we should increase that coverage probably to 150 and 200 companies within the next year as we've grown our team. We cover 100 companies, got our own valuations on all of them, and we've tracked the discount to intrinsic value over time. In red, it's when the buy list doesn't offer value, and in green, it's where it offers extreme value. What we've seen just of late with the way stocks have sold off is it's one of the largest potential returns on our buy list we've seen in years. The last time we saw this was through COVID. And what's important, infrastructurally, is that we follow the buy list. We don't second guess ourselves. We're not looking out the window, guessing, using our ears for navigation. We've got the tools in front of us. We've done the work. So we follow the buy list. The buy list says there's huge opportunity to buy equities, particularly many of those that have been sold off that are cheap. And we followed that, and the blue line represents our asset allocation in equities, rising every time the buy list offers value. We of course sell high as well. You can see that we de-risk the portfolio when the buy list enters a zone where equities no longer offer value. And that's led to great performance over a decade. And we're in red, and their peer group is in blue. And the equity part of our flexible fund is in red here against other equity managers, also outstanding performance. But below the bonnet of the car, And the single lines represent the paintwork of the car. Below the bonnet is the real mechanics of what we do. And our hit rate on the left-hand side, or I see it on the left-hand side here, is the number of stocks in our portfolio every year that beat the index. We're in white, the index is in blue. The win-loss ratio is the ability to pick winners that outperform the detraction that happens from losers. A ratio over 100 tells you that the winners are adding more value than your losers are detracting in your portfolio. And our alpha, out of 13 years, 9 of them we've delivered positive alpha. So if we sum that up, 57% hit rate, 143% win-loss ratio, and almost 2% annualized alpha. But we have been humbled in 2026. It's been a terrible 4 months for all quality managers, really. And we just show the retracement we've seen in our own portfolio, both at a flexible fund level and on our equity level. But here's the interesting kind of rub. This is a graph that uses the different cohorts of different stocks in the market based on the return on capital. So what's interesting, in the last 4 or 5 months of the year, is the best returning stocks in terms of ROICs have had the worst performance on the market. A little bit like saying the best farms that yield the highest have been sold off, and the worst farms that yield the lowest, which are the stocks between like 0 and 30% ROICs, have been repriced upwards. So we've had a strange dislocation in the markets. Now, if we just look at our performance over time, we're in blue, and the quality managers, many managers are in all the other colors. We kind of done very well over many, many years. But the last few months suffered like the pack. And I just want to raise 1 or 2 last slides with you. This is a manager we rate very highly. They've got $8 billion under management, and I'm sure a lot of you will have your money with them, a quality manager. We rate them. I actually listen to him every now and again because I really do believe he's a leading mind in the industry. And he too has had a tough time, so no one's alone in the quality space. And this is another manager that's more pragmatic and drifts away from quality, but likes to say that they own good businesses. They've got $30 billion. What's intriguing is from 2017 to 2024, they underperformed the market. $30 billion. The gray space on the slide shows the extent to which they underperformed the market. Yet they stuck to their principles, they stuck to their buy list, they didn't look out the window and concern themselves with the weather. And the massive returns seen in the last 2 years led to extreme outperformance. So I'll make a point here. They stuck to their guns and their clients stayed with them, and everyone landed quite safely. So just really in conclusion, what's been tough is the software trade for us just this year. We always make our own mistakes. So every year we get about 40% of our stocks wrong. And the war has really hurt a lot of companies that we think are ridiculously undervalued and will reprice upwards. So in conclusion, what makes us win over time? We have a philosophy that's just a no-brainer. Would you rather own a flat in Newlands when the market comes under some pressure and you can get a 10 or 12% yield and you can buy it at a 30% discount in Cape Town? Or would you rather buy a block of flats in Hillbrow? We prefer the block of flats in Newlands at the right time. It's one way of putting it. It's reliable, you can bank it. The process is deep, it's bottom up. We have a lot of people working on it daily, and we're extending our team. And the team is growing. We're going to have 8 analysts just on global by the end of this year. So we really aim to cover 200 stocks globally. So, we think in decades, not in days. And we certainly have no intention of blinking currently. Thank you very much.